Well, welcome everyone to today's MGAA market briefing. Very happy to have with us Fiona Robertson, from Insurance Insider. So I will be handing over to Fiona in a very quickly. But first of all, I just wanted to do some housekeeping. For anyone that has attended these before, it is the same instructions. But just a quick reminder to keep cameras and microphones off, so it helps us with the technology. Also to ask if you have questions as we go through, please add them into the chat, and we will cover those off at the end. Also remind you that the session is being recorded, but that means that we'll be able to send you a link to the recording if there's anything that you want to reflect back on and review afterwards, or if you want to highlight it to a colleague who might have missed the session. Also, just a reminder that our sessions are accredited by the CII, so that does mean if they meet with your development needs, you can record them on your CPD log. So that leaves me to introduce Fiona Robertson from Insurance Insider, who is going to take us on a little journey behind the headlines. So without any further delay, I will hand over to you, Fiona.
Thanks, Alison. So yes, I'm Fiona Robertson. I'm the editor of Insurance Insider. I lead our London-based editorial team. I've been with the company for about 15 years, so I've seen quite a lot of change in the insurance market over that time. A lot of my personal background is in covering our reinsurance, our ILS and our Lloyd's, leading our coverage in those areas. So not so much MGAs, but obviously we do have a broad focus on the market. And what I'm here to talk to you about today is a little bit of the Insurance Insider editorial's take on what the trends for 2026 are going to be. So I hope it's useful for you. So I guess first off, it feels very much like if I had to sum up 2025, it's been really a year of transition where the market is still on track to achieve strong returns, but you can see that there's nerves around rate softening that are very much starting to kick in. So I'm going to start off talking about what that means for top line targets and how they're getting harder to achieve. And then we'll touch on one of the knock-on implications of that trend. Quite a welcome one as a journalist, I think, in that we're starting to see a lot of M&A deals. And then we'll look at another trend around how companies are dealing with this dynamic, maybe slightly less exciting, but still important, to do with efficiencies. And finally, I will touch on a newer trend that's picked up pace this year around the role of credit investors briefly. And if we could go to my first slide, Alison, I think one way to underscore what the year of transition means for the market is that to think back to what we were talking about a year ago. So quite often at Insurance Insider, we like to do our sort of look ahead pieces or our summaries of the year on an annual basis. So when I looked back to what I'd been talking about this time a year ago in terms of themes for the future, we were talking at that time about these big game hunting trophies for Lloyd's, as we called it. So that's referring to the big name entrants that had come into the market at that time. So Stephen Catlin, Richard Brindle, and a year on, and it's still been a very active year for new launches at Lloyd's and lots of new startup activity. But I think if we move to my next slide, you can see that there's been a clear vibe shift from the new CEO, Patrick Tiernan, around the messaging on growth. And so you can see that the corporation is still looking to find growth from new sources, and that might be new business types like credit risk or regional brands like Santam. But the discussion around top-line growth as a goal in itself has submerged. And if we move on to the next slide, then you can see why that is the case. Because when you look at 2024, so even a year ago, there was very little support for top-line growth from rate gain. And this year, of course, that rate factor has dipped down into the negative territory and is actually an active headwind. So the result is that top-line figures are coming down below forecasts for the year. And across Lloyd's as a whole, the GWP is expected to be in the low 60 billion ballpark, down from prior estimates of around 65 to 66. So that for Lloyd's as a whole, that's still quite good growth over 2024. So it could be as much as 10% or more, depending on the final outcome that gets posted after year end. and that reflects on the new business that they are trying to get in. But it's not just a Lloyd's issue. And if you look at some of the largest carriers in the market, such as Beazley, which posted 2% growth in H1 this year, you can see that momentum is becoming harder to maintain. And this is basically the key challenge that every carrier in the marketplace has faced over the past year. And that's how to walk a tightrope between seeking organic growth and continuing to deliver growth without compromising on rate. At the moment, the carriers have excess capital and delivering combined ratios of sub 90% range. The returns have been strong, more than 21%, 25% in the Lloyd's context. So it's the kind of stuff that really draws investors in for more. And the dilemma is that while rates are still good enough after years of correction, the more that carriers strive for growth, the more that competition is going to erode that baseline rate. And so that underlying dynamic has some obvious implications. And the first one that I want to talk about is that carrier M&A is back on the agenda. And if we move on to my next slide, you can just tell by how fast this is moving in just the speed at which carriers are getting ticked off on that list. So about a month ago, I think 3 of those carriers would not have had a tick next to their name as having done their M&A deal. But we can't say we didn't see it coming. At Insurance Insider, as early as July 2024, we were writing about the fact that we thought the carrier M&A cycle was about to kick into gear, and we were exploring several reasons for that. The first was that growth was about to get harder and excess capital would start to burn a hole in executive pockets, if you will. Multiples also had strengthened, so acquirers would have stronger currency to finance any deals they might want to do. And obviously it's quite the pivot because brokers have really been in the M&A headlines for a long time and continue to get sort of better valuations. But when you look at the 18 months since we wrote that article predicting carrier M&A would start to arise, there's just been such a quick flurry of deals struck. And I don't think that's surprising either that we've seen deals getting done fast, given that there is this noise around the shift in the rate cycle. And, investors talking about the fact that, yes, there will be interest in acquisitions, but there might only be a few potential partners for each firm. So if you have this perception that the ideal buyers are scarce, management might well want to get in and get their deal done early within the M&A cycle. But yeah, 3 deals in 1 week last month was quite something. So let's see what happens in the future. So what else can we see from these deals that have been done so far? If we move on to my next slide, it shows that there's clearly interest in what we are calling the Carrier Plus model. And this does, I think, as a point of terminology, have an advantage of getting us away from talking endlessly about carrier bifurcation a la Fidelis, which did seem to be the case maybe last year. And it's perhaps more achievable than a full restructure as Fidelis went through. And Atrium really showed how the Lloyd's systems in particular can lend itself well to agency sales. It effectively sold the agency part of its operations to CRC, and Stowe Point kept the risk-bearing corporate member. But even Apollo or Aspen, which were more conventional sales, when they came to discuss their deals, really played up the part of the importance of the fee-earning parts of their business. And I think that given that, the potential is there for fee income streams to attract a higher multiple in the process or to open up a wider range of buyers, we might expect that other sellers will be trying to do the same where they can. And I think this could potentially drive more interest in those kind of fee-generating platforms in the coming years. We've seen signs of some new MGA launches that have yet to fully play out, from Convex, for example. And I think it's also possible that with the interest in MGAs, we could see more reinsurer focus on the allied world of ILS platforms as well. And we've also written about excess third-party capital appetite at Lloyd's and the funds at Lloyd's market. So I think using names or other third-party funds at Lloyd's could be another avenue that companies will pursue, as we've seen startups do over the past year as well. So if we move on to my next slide, I said at the beginning that M&A is sort of the exciting engine for growth, and that the other way that you might want to start trying to get more out of your results when the market gets tough is to put a focus on efficiencies and expense saving. And I said that might not be as exciting, but actually I think that's slightly underplaying it because there's a couple of areas in particular that I want to look at where the industry attention has been focused on improving productivity in a way that also drives greater scale. So it's an age-old theme, I think, to try and find ways of saving money in a softening market. But I think these are new ways of doing that are quite innovative. And the two ways that I want to talk about are AI investment and distribution facilities. So broker facilities and smart follow underwriting are already showing how scale can be gained through these routes to market. Key Group was at more than $1 billion in premium last year already, for example, and it's across both their syndicate and other key endeavours. And there has been progress on bringing down expense ratios as well, although it's been a little bit less linear, as you can see from these graphics. Key also, in fact, made an underwriting loss this past quarter, given that it incurred some extra costs relating to its separation from Brit. So I think there are also some early signals that we might start to see growth in smart follow get a bit more lumpy because there is, it seems, a bit of reliance on what we are thinking of as lead followers. So the followers in this space who are developing really big portfolios, have good technology and can lead a facility. So that I think has yet to play out. On the AI front, meanwhile, there are investments that are starting to come to fruition now. There's still relatively limited public examples, I would say, with detail on what's being launched and how it works. But there is a lot of conversation around how AI can improve underwriting accuracy by enabling better understanding of risks. And so if we move on to my next slide around AI, one thing I would refer to is that I think in as much as a lot of AI relies on technical investment and what can these projects do for you technically, there's still a lot of work to go into the messaging itself around the outcome of AI investment. And earlier this year when we interviewed Swiss Re's CEO, he told us that of 3 keys to success, 2 of them, as he saw it, I would say, centre on messaging, and that's motivation and inspiration. So the messaging needs are probably going to be quite different for different groups. For public market investors might be more keen on the savings. Your internal stakeholders might need more messaging around the sort of excitement of what you can do from AI. And so far, a lot of companies within the internal messaging seem to be focusing on the idea that AI isn't taking your jobs. And in some cases, that might be true. But if we go on to my next slide, I think, so it might be, that technology could help free people up to focus on different parts of their job or simply to get by without hiring as many staff as they might have in the past. But I do think there's a risk that these attempts to be reassuring may not always succeed because if your company is investing in AI, it's fairly obvious that it wants to create some efficiencies and change the way the workplace functions. Otherwise, why invest? And our reporting recently has shown that insurance, along with other industries, of course, is bringing in fewer new graduates. And I think AI is only going to work if a company is able to really bring its employees along with it to actually adopt the new tools and make use of them. So I think the industry needs to tread a fine balance here between going after those savings and setting themselves up for future success. And onto my next slide. So far, I've really been discussing pivots that are within the insurance market cycle. But insurers obviously are impacted by external market cycles as well. And there's one particular topic of intersection that I want to pick up on. So any disciple of Warren Buffett's knows about the power of insurance float. But this year, we're getting an example of how private credit investors are buying into this vision. Whether it's through a casualty sidecar or a captive reinsurance vehicle, they want their slice of float. For now, this is still very much an emerging market, but I think there is a risk of disintermediation in some cases. So if you look at a captive reinsurance vehicle, that's taking premium out of the market and it's putting pressure on the remaining part of the open market program. So there is a high barrier to doing deals like that. So the AIG Blackstone syndicate would have taken a lot to get done. We haven't yet seen the next one, although I don't think it'll be too far away. So it might not be a high volume trend, but if you think about the fact that if all the largest reinsurance buyers in the world adopted it, it could still be a meaningful amount in terms of premium volume. And I think where we've seen a bit more volume of activity is probably on the sidecar front, so casualty sidecars. So far, I think there's no real signs of that changing reinsurer behaviour, if you think of the fact that it's essentially providing them with retro cover. And I think that's probably because the casualty market is still obviously very highly divided on reserve adequacy and the threat of social inflation. So that's providing a bit of a safeguard. But ultimately, these casualty vehicles are still very nascent. It's a nascent market, and we do have some questions about how that will play out. Could, for example, the off-balance sheet exposure to credit risk come back to bite carriers who haven't really historically done very well at understanding this risk, as we saw in the 2008 crisis? And on the investor side, will their expectations be aligned on the degree of risk that they're taking when in 7 years' time, if casualty market loss ratios start climbing? So those could be sort of pressure points for that new market. And these are obviously just, 4 themes that the market's facing right now, a few of many. It's a very dynamic market and one that I think will keep shifting in the year. But if you go onto my final slide, you will find that if you are interested in trying to stay on top of all those trends through access to Insurance Insider, there is a way for you to get a free trial here through scanning the QR code. And that's really all I wanted to say in terms of formal remarks. I think we do have some time for a little bit of Q&A.
Yeah, thank you very much for the update. Hopefully my camera will pop up in a minute. There we are. So yeah, thank you ever so much for the update. I'm just checking on the chat, and at the moment we don't have any questions come through. So I think that may suggest that your update has answered any queries that people had in terms of what were the main headlines and what's the information behind them. So I was just obviously spoke too soon. We have a question. So what are the implications of carrier M&A? Any benefit from replacing PI-backed syndicated with permanent capital?
Yeah, I do. I do think there is a benefit to carriers getting more permanent capital. You can see where in cases like the Convex sale, where Stephen Catlin said that their new source of capital was as close to permanent as you can get. So that was clearly an attraction for them in terms of who they sold out to. I think it just removes, particularly in an industry where it's so cyclical and, your profit goals are really dependent on not necessarily having to chase a top line figure. I think that there is a benefit in having an investor with a much longer term time frame than the typical PE investor might have. And I think the implications of carrier M&A maybe have a little bit more, we'll just need to see how they play out. I think one thing that's interesting so far is that we're not necessarily seeing consolidation plays so far. So if you look at Inigo and Radian, for example, they're very different types of companies. There's not a lot of overlap. So for Inigo, they just keep on doing what they do. Maybe Sompo Aspen, there will be a bit more overlap. But I wonder personally whether that might lead to, sometimes you see soft market M&A as consolidation as a means to pull capacity out of the market a little bit through that consolidating effect. And I don't know that they will necessarily see that as quickly as you might have otherwise. So I think that's interesting to watch for.
Thank you very much. Let's have a quick check and see if we have any more come through. Not at the moment, but what I can do is do a bit of a protracted thank you in just in case anyone is typing. I would hate to cut them off. So yes, again, thank you ever so much for spending the time to provide us with that update. It's very useful. It is recorded, so I know there was a lot of people that registered, so I will get it quickly edited and out to everyone as yeah, so that the headlines are still headlines at the point that the recording goes out. And I think in terms of questions, there haven't any more popping up. So unless anyone shouts very quickly that they've got a question, I think it just leaves me to yes, thank our audience. We have some claps, so I feel reassured that I'm not cutting anyone off too soon in terms of the questions. So yeah, thank you ever so much, Fiona, for your time, and thank you to everyone that has attended.